Welcome to the deep dive. Today, we're really going to try and give you a shortcut into understanding global index investing.
Yeah, it's become such a huge topic. We want to look at why it's so dominant now.
Exactly. What it means for building long-term wealth, and maybe some, surprising details you really ought to know.
We've sifted through a ton of research, lots of data, and the goal here is just to distill it down, give you the essentials.
Right. So you're informed on the core benefits, but also maybe the trade-offs people don't always talk about.
We'll look at active versus passive investing, why one seems to consistently win out over time.
And what that actually means for your money, your portfolio.
Okay, so let's maybe start at the beginning. Index investing.
Mm-hmm.
What is it, really?
At its heart, it's about buying the whole market, right? Not trying to pick the winners and losers.
Precisely. An index itself, like the S&P 500 everyone talks about, it's just a list, a statistical measure. You can't actually buy it.
Ah, okay. So how do you invest in that basket then?
That's where index funds, or often ETFs, exchange-traded funds, come in. They're the tools, the vehicles designed to just mirror that index, track it really closely.
So one share in, say, a global index fund means you effectively own a tiny slice of thousands of companies.
Yeah, could be thousands.
Yeah.
Instantly spread out, diversified, without you having to research or buy individual stocks.
Okay, that sounds powerful. What's really driving this passive revolution? It feels like there are some fundamental advantages.
There absolutely are. Its success really rests on, I'd say, three key pillars. Structural advantages, almost.
Okay, lay them out for us. What's number one?
Well, the first and arguably the biggest impact on your long-term results is just incredibly low costs.
Right, compared to active funds, which can charge, what, 0.5%, 1%, sometimes even more every single year?
Exactly. Whereas broad index funds, especially ETFs, you're often looking at under 0.10%. Some are even down around 0.03%.
Wow, that sounds tiny, but I guess it adds up.
Massively. Think about paying, say, $3 versus maybe $75 or $100 for every $10,000 you invest year after year, compounded over decades. It's a huge difference to your final wealth.
Okay, cost is huge. What's pillar number two?
Diversification. You hear it called the only free lunch in finance.
Huh, yeah. Because you're spreading your bets, basically.
Right, spreading risk across tons of companies, different sectors, different countries even. If one company tanks, it doesn't sink your whole portfolio. It smooths things out.
Makes sense. And the third pillar?
Number three is tax efficiency. Index funds tend to buy and hold. They don't trade very often, very low turnover.
Which means fewer capital gains taxes triggered along the way for you, the investor.
Exactly. And ETFs have this neat trick, an in-kind redemption process. Big institutions can swap blocks of stock for ETF shares, avoiding sales that would trigger gains distribution. It helps keep taxes low.
Plus, it sort of encourages that buy and hold mindset, stopping you from panic selling when things get choppy.
It definitely helps foster that discipline, which is crucial. Avoiding emotional mistakes is a big, often overlooked part of success.
Okay, the theory sounds good, low cost, diversified, tax efficient. But what about performance? Does the real world data actually back this up? Because you always hear about SAR managers who do beat the market.
That's the critical question. And the evidence, especially from groups like S&P with their SPVA scorecard, is just, well, overwhelming.
SPVA, what's special about their data?
They're really careful to correct for biases. The big one is survivorship bias.
Ah, where the bad funds just disappear.
Exactly. They get closed or merged away, so historical data looks better than reality. SPVA found almost two-thirds, like 64%, of U.S. stock funds vanished over 20 years.
Whoa, so when you account for that, what's the verdict on active versus passive?
It's incredibly consistent. Year after year, the vast majority of active managers failed to beat their benchmark index. We're talking over 90% in many U.S. categories over 10 or 15 years.
90% fail.
Over the long haul, yes. And it's not just the U.S. You see this pattern globally. It's really hard to consistently outperform the market minus fees.
And that global point is key, isn't it? Just owning, say, the S&P 500 means you're missing out on a huge chunk of the world economy.
A massive chunk. You really need to think globally, but be aware of what index you're tracking.
How so?
Well, something like an MSCI World or FTSE Developed Index, that's only developed countries, US, Europe, Japan, etc.
Okay.
A truly global index, like MSCI ACWI or FTSE All World, includes both developed and emerging markets, China, India, Brazil. You get thousands more companies, much broader exposure.
Yeah.
FTSE All World even includes small cap stocks globally.
Got it. So go global, but know what global means for your specific fund. Now, it can't all be perfect, right? What are the downsides or risks with indexing?
No, it's not perfect. A big one is you get zero downside protection. If the whole market crashes, your index fund crashes right along with it.
No active manager trying to sidestep the worst of it.
Right. And because it's rules-based, it has to buy stocks as they get bigger and more expensive. It's forced to buy high in that sense. No flexibility.
And isn't there a risk now? Like concentration.
Absolutely. That's a huge topic right now. The Magnificent Seven tech stocks, Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, Meta,
Yeah, they're massive.
they now make up something like 32 to 34% of the S&P 500. So your diversified U.S. index fund is actually heavily bet on just a few massive tech companies,
Which kind of undermines the diversification benefit we just talked
which
about.
certainly complicates it. And this leads to another big point to it. The sheer power concentrated by indexing.
You mean with the big fund company?
Yeah, the big three, BlackRock, Vanguard, State Street. Because they manage so much index money, they end up being among the largest shareholders in almost every major company.
Controlling huge voting blocks.
Collectively, maybe over 20% of the votes in typical S&P 500 companies. That's immense influence. That's sort of the blessing and the curse of indexing success.
Okay, so bringing it back to the practical side for someone listening, how do they actually implement this? ETF or mutual fund?
Good question. ETFs generally have a slight edge on tax efficiency in regular taxable accounts, and you can trade them throughout the day like stocks.
And mutual funds.
Mutual funds can sometimes be simpler for setting up automatic, recurring investments, like in your 401k or IRA. Often no commissions for those regular buys.
But regardless of the wrapper, ETF, or mutual fund, what's the number one thing to look for?
The total expense ratio, or TER, the fee. Lower is almost always better. That's your biggest controllable factor for long-term returns.
Okay, so wrapping this up, what's the final take?
Well, look, global index investing generally wins out. It's cheaper, it's broadly diversified. The historical data shows it consistently beats most active managers long-term.
And it encourages good investor behavior, that discipline we mentioned.
Exactly. You can't control what the market does day to day, but you can control how much you save, what fees you pay, your tax strategy, and crucially, your own reactions.
Those are the levers you can actually pull to build wealth.
Absolutely. And maybe a final thought to leave people with.
Yeah.
As you think about all this, consider that immense power we mentioned, concentrated in those few large asset managers because of indexing's rise. What does that concentration mean for how companies are run, for corporate governance, maybe even for how capital gets allocated across the economy?
That's a heavy question. Definitely something to mull over. It really shows how interconnected all this is.